Welcome back. Well, all that glitters is proving to be gold for Pan-African Resources. During the half-year period, the yellow metal miner delivered a 6.7% rise in production and a 46% jump in headline earnings per share to over 2 US cents. The upbeat performance was mainly due to tight control measures and a favourable gold price. And joining me as we dig deeper into its numbers is company CEO Cobus Loots. Thank you so much for your time, Cobus. Let's actually start off with that gold price. How much of a boost was that shinier gold price on your overall performance?
The gold price certainly gave us a very nice tailwind in US dollar terms, but even more so in rand terms. So the current gold price is at an all-time high, almost, from a rand gold price perspective. And obviously that's a very big boost for us. But we're not relying on this really elevated gold price. I think operationally we did a lot better. So production was up, and then we obviously also controlled costs quite nicely.
All right. Well, one of the things, of course, as you mentioned, costs that jumped out at me is the reduction in all-in sustaining costs. And I mean, that's actually not something that we have been seeing lately from the mining space. How have you managed this?
Well, the best way of reducing costs is by producing more ounces. In mining, most of your costs are fixed. And that means, obviously, the more units of production that makes your unit cost a lot more attractive. And I mean, we managed to ramp up production actually across the board at our Evander underground, at our Ekulu tailings retreatment operation, and then also at the Barberton underground, and principally at the Fairview mine at Barberton. Production was up also following the implementation of continuous operations last year.
Well, as we're talking about costs as well, I mean, of course, electricity generation is a big part of that cost base for miners. You do expect renewable energy to contribute to cost reduction also going forward. Where are you in that renewable energy effort?
So we're quite proud of our achievements to date as far as renewable energy is concerned. We were the first South African miner to commission a utility scale at our Evander mine. It's about 2 years ago. And that operation now, the solar facility at Evander, is saving us $13 per ounce from an all-in sustaining cost perspective. We're about to commission our second plant now at Barberton. That'll be done by June of this year, almost also 10 megawatts. And then we've also signed a power purchase agreement for 40 megawatts. And what we've also said to the market is that they can expect some further announcements from us on renewables in the period ahead. So we're quite excited about our roadmap and footprint as far as renewables is concerned. It obviously assists us from a cost reduction perspective, from a reliability perspective, and then also importantly from a renewables, so from a green perspective as far as ESG is concerned.
Yeah. So would you say that your CapEx priorities have maybe shifted a little under this current economic environment?
Well, we always continue to reinvest in our assets, and the great thing with Pan African's portfolio is that we have long life assets. Both Barberton and Evander will go for more than 10 years plus. And then also what the Mogale or Mintails that we're currently developing on the West Rand, that'll be a 20-year life. So our first port of call for capital is reinvesting in our assets, and then obviously achieving that balance between growth from a production perspective and also giving returns to shareholders in the form of dividend. Yeah. And we continue to be sector leading as far as our dividend payout is concerned.
I mean, on that also, how deep is your capital expenditure pipeline, and does it need debt?
Well, we do have debt facilities, but our debt's very manageable. So debt's not a bad thing if it's done for the right reasons. And a project like Mogale, which we're developing, the capital bill for that upfront is about $135 million, which is not insignificant. But for that, you're going to get a plant that produces 50,000 ounces a year for 20 years at an all-in sustaining cost of about $900. Very attractive. The payback on that initial capital investment will be in the order of 3 years in the current gold price environment. So that's the sort of rationale. If you want to incur debt, those are sort of projects that you would take on debt onto your balance sheet for.
Yeah.
But despite all the capital we're spending, our assets are generating also attractive cash flows. So even with the increase in debt as a result of Mintails, our debt levels are very comfortable at this point.
Yeah. So would you say that your operations are more optimized, and also that you are engaged in opportunities to optimize your operations to withstand the volatility in the macroeconomic environment?
Yes, 100%. I mean, our assets are long life and they've been going for a long time. It also tells you something about the quality. Barberton started mining almost 140 years ago. So that's quite a nice track record.
All right. And also, I mean, what can investors look forward to in terms of extracting value from the company in the short to medium term?
Well, I think we've nicely on track to meet our production guidance for this year. It was a very strong performance in the first half. The gold price tailwinds, if it persists, it'll definitely also give us a boost. And then there are very few companies that in the next year can manage, like we will, to increase production by 25% or more. And those are very high margin ounces because of the fact that they're so low cost. So we're one of the few producers that can significantly and materially grow our footprint in the short term, which is what we're doing.
All right. Well, thank you so much for your time and just detailing those numbers that came out of Pan African Resources. That was the CEO of Pan African Resources, Cobus Loots.